Imagine this. You're at a lively party, the air buzzing with laughter and clinking glasses. Suddenly, you catch a hushed conversation from across the room. Someone leans in, their voice barely above a whisper, sharing a secret that seems too important for casual gossip. The topic? A major company? A revolutionary new product about to launch? Or perhaps a merger that could shake up the entire industry? The people talking aren't just speculating. They seem to know something the rest of the world doesn't. This isn't just idle chatter. It's privileged, confidential information. The kind of secret that, if acted upon, could change someone's financial future overnight. Imagine knowing exactly when to buy or sell a stock, riding the wave of a company's success before anyone else even sees it coming. The temptation is undeniable. This information could make you rich, fast, with just a few clicks or a single phone call. This, my friends, is the seductive whisper of insider trading, a world where secrets are currency and knowledge is power. It's a game played in the shadows, where a single tip can mean the difference between fortune and failure. Here, deals are struck behind closed doors, advantages are hidden from the public eye, and the stakes are incredibly high. The promise of massive profits lures people in, making it easy to forget the risks and the rules. But here's the catch. It's not just risky, it's illegal. The law is clear. Using inside information to trade stocks is a crime, and the consequences can be severe, from hefty fines to prison time. While insider trading might seem like a shortcut to wealth, it's actually a dangerous game that can ruin reputations, careers, and lives. The fear of getting caught, the stress of keeping secrets, and the constant worry about who might be watching, it all adds up. At its core, insider trading is built on unfair advantages. It undermines trust in our financial markets, making the playing field uneven and eroding the confidence that investors need to participate. In this article, we'll pull back the curtain on insider trading. We'll explore why it's considered so harmful, how authorities track down and punish offenders, and why a fair, transparent market is essential for everyone, from small investors to giant corporations. So, buckle up as we journey into the secretive world of insider trading. Together, we'll discover why, in the end, playing by the rules isn't just the right thing to do. It's the smartest investment you can make. Let's break down this complex issue, because insider trading is a term that gets thrown around a lot, but not everyone knows exactly what it means or why it matters. So, let's turn this complicated financial concept into something we can all understand, no matter your background or experience with the stock market. Imagine your friend Sarah works at a cutting-edge tech company that's on the verge of launching a revolutionary new phone. This isn't just any phone. It's packed with features that could change the industry and attract millions of customers. Sarah knows before anyone else that this phone will likely be a massive success, and that news could send her company's stock price soaring once it becomes public. Now, if Sarah secretly tells you about this upcoming launch before the information is made public, and you decide to buy shares in her company based on her tip, that's what we call insider trading. You see, Sarah has access to what's known as material non-public information, details that are both important and not yet available to the general public. It's called material because it's significant enough to influence an investor's decision or affect the company's stock price in a big way. And it's non-public because at this point only a select few insiders know about it. The general public, including most investors, are still in the dark. When you act on this insider tip from Sarah, you're gaining an unfair advantage over everyone else in the market. This is why insider trading is illegal, because it undermines trust, creates an uneven playing field, and can seriously damage the integrity of financial markets for everyone involved. Think of the stock market as a giant poker game, where every player is hoping to win by making smart moves and reading the table. In this game, just like in poker, everyone is supposed to play by the same rules, relying on the information that's available to all. The excitement and challenge come from making the best decisions you can with what you know. Everyone at the table should have the same information to make informed decisions about their hands. In the world of investing, this means that all investors, big or small, should have access to the same facts and figures before they decide to buy or sell stocks. This is what keeps the game fair and competitive for everyone involved. Now imagine if someone is secretly peeking at another player's cards, getting a glimpse of information that no one else has. Suddenly, that person has a huge advantage because they know things others don't. They can make moves that seem lucky, but are actually based on hidden knowledge. That's essentially what insider trading is, cheating in the financial markets. It's like someone breaking the rules of the game to get ahead, using secret information to make sure they win while others lose. This kind of behavior isn't just unfair, it's dishonest and undermines the spirit of competition. When insiders like Sarah use their privileged information to profit, they create an uneven playing field. They're not just getting lucky, they're using knowledge that's off limits to everyone else, stacking the odds in their favor. This means regular investors never really have a fair shot at winning. Ordinary investors who play by the rules are left at a disadvantage. They trust the system and make decisions based on public information, but they can't compete with those who have secret insights. This can lead to frustration, disappointment, and even financial loss for honest players. They're making decisions without the full picture, while insiders are cashing in based on secrets. It's like trying to win a game where someone else already knows the outcome, leaving everyone else feeling cheated and powerless. This undermines the entire system, making people lose faith in the fairness and integrity of the market. When people believe the game is rigged, they're less likely to participate, which hurts everyone. That's why stopping insider trading is so important. It protects trust, fairness, and the very foundation of our financial markets. Insider trading isn't just unethical, it's illegal. Why? Because it strikes at the heart of fair and transparent markets. When people believe the market is rigged, they're less likely to invest. This can have a ripple effect, hurting businesses trying to raise capital and impacting economic growth. Laws against insider trading are designed to protect the integrity of our financial system. They ensure everyone has a fair shot at success and maintain investor confidence. These laws are crucial for a healthy economy, allowing businesses to thrive and investors to participate with trust. Over the years, there have been numerous high-profile insider trading cases, proving that no one, regardless of their wealth or status, is above the law. Take the case of Martha Stewart, the lifestyle guru. She was convicted in 2004 for selling ImClone system stock based on a tip from her broker, avoiding a significant loss. Then there's Raj Rajaratnam, the billionaire hedge fund manager found guilty in 2011 of running a vast insider trading ring. These cases, among others, serve as stark reminders that insider trading carries severe consequences. The Securities and Exchange Commission, or SEC, is the main agency responsible for policing the markets and enforcing insider trading laws. They act as the guardians of Wall Street, working tirelessly to detect and prosecute those who violate these rules. The SEC investigates suspicious trading patterns, monitors communications, and even uses wiretaps to catch insider trading rings. The penalties for breaking these laws are severe, often including hefty fines, disgorgement of profits, and even jail time. Ultimately, laws against insider trading are about protecting you, the everyday investor. They ensure a level playing field where your hard-earned money has a fair chance to grow. When we maintain the integrity of our markets, everyone benefits. Businesses can raise capital, investors can participate with confidence, and the economy can thrive. So the next time you hear someone bragging about a hot stock tip, remember the importance of fair play. Investing should be based on sound research and analysis, not insider information. By playing by the rules, we all contribute to a stronger, more equitable financial system.